Today, I am joined by Noel Smith of Convex Asset Management. Noel is a veteran prop trader as well as an options trader. He deals in treasury bonds, in commodities, in futures and options, and in stocks. I'm so glad to have him join us. Noel, welcome to Real Vision.
Thank you for having me.
Yeah, it's great to have you back. You did an interview with Mike Green 2 months ago where you sort of shared some of your war stories from being in the trading pits of Chicago. Now I want to get a little bit into the weeds of the different strategies that you run at Convex Asset Management. But first, Noel, I just want to say that you sort of do what a lot of people who subscribe to Real Vision want to. You really are someone that they look up to because you are a proprietary trader. You've been running your own money for many decades, consistently beating the S&P 500. So kind of what I want for this interview is for you to share your secrets, so to speak.
Sure. So what we've done is we've taken really the best ideas from prop trading and bringing them to the hedge fund space. So what we want to bring to our investors is a suite of strategies that we have been trading for over 20 years for various different reasons that have nothing to do with each other and have nothing to do with probably the rest of the book. So low correlation to each other and lower correlation to the marketplace as a whole. And these profit centers are derived, like as you said, from the commodity market, from the fixed income market, from the equity market, and probably most relevantly from the volatility market, because we use volatility as a way to inform our trades, as a way to figure out how to make money and where we make these decisions.
And with hedge funds, they really are targeting returns of getting 10%, 15%, but a lot of what they're targeting is low volatility so that their clients can see that their portfolios are going up, just grinding higher month after month. With a prop trader, you can tolerate swings in a much greater fashion. So you're down 10%, up 10%, down 30%, up 50%. Tell us a little bit about what's that like, and how do you compare, having been in both seats? What is it like running a prop fund where you're running your own money versus a hedge fund?
It's very different. So if I'm driving my car and I'm in a car chase, I will drive it as vigorously as I know how to. If I'm in a borrowed car that my whole life will blow up if I crash it, I will drive it much more cautiously. So let's go to specific examples. September 11th, 2001. We all know what happened then. Going into that, this is like the thing of folklore, but this is real. I was short a bunch of airline puts going into this. That was a real thing. And the reason it became part of folklore is because it's rooted in reality. So going into September 11th, they were buying a lot of puts in airlines and I was selling them and I was selling them at what seemed to be very good prices. September 11th comes and, I wasn't sure if they would attack our building because we were in Chicago in a high rise, specifically at the exchange. So that was on the radar. And, we lost a lot of money and the exchange was closed for a week. And if I was a hedge fund, I might have blown out. We were down something like 20%, maybe more. Even the 20% thing is kind of funny because 20% based on what? Based on where it closed the previous Monday or based on what was going to open the next time around? So while the market was closed, we really had no idea if we were out of business or not.
Sorry, no, if I can interject, you were long puts or short puts?
Short puts. Short puts.
Okay. So that is a long positive delta experiment. You're basically selling insurance on airline stocks, and surprise, during 9/11, airline stocks crashed. So that you were deep in the hole. Yeah.
Of course. Yeah. We were short puts and we were long exposure to airlines and we lost a lot of money. But going back to the point, so we made all that money back by November. We had no idea that was going to happen. But what happened was the market was so busy and there was so much business to be done and options prices had increased so much that we were able to make back our losses and then some. Now, if I were in a hedge fund or a vol control fund, I would necessarily have to de-risk, accept those losses and just accept the losses. But in a prop firm, we are much more nimble. We can do a lot more with a lot less. And we can trade around what's going on. And then we can take new opportunities and trade them as though they're fresh.